Ethereum has become one of the most misunderstood assets in crypto this year. In 2025, it feels like ETH has been taking punches from every direction. Bitcoin has mostly moved sideways, Solana grabbed attention with its memecoin frenzy, and Ethereum, once the undisputed king of smart contracts, has been treated like the market's biggest disappointment. Weak price action, underwhelming ETF demand, and a growing narrative that Layer 2 networks are draining value from the main chain have pushed sentiment to extreme lows. The ETH to BTC ratio looks ugly, and the overall mood around Ethereum is arguably worse than it was during the depths of the 2022 bear market. But here is where things get interesting. While retail traders are panic selling and calling for ETH to drop to $1,500, the world's largest financial institutions are quietly choosing Ethereum as the foundation for the future of finance. That raises a critical question. Is Ethereum actually in terminal decline, or are we staring at one of the strongest contrarian setups heading into 2026? Welcome to Web3 Verse. Today we are cutting through the noise to separate fear from facts and understand what is really happening with Ethereum. To answer whether Ethereum is finished or simply hibernating, we need to start with the wreckage that was 2025. From a performance standpoint, it has been rough. Ethereum spent much of the year lagging behind both traditional markets and competing blockchains. While major tech stocks surged, ETH struggled to keep up. Against other crypto assets, the contrast was even sharper. Solana dominated headlines with explosive activity, while Ethereum appeared slow, expensive, and outdated in comparison. That said, the price story was not one-directional. In early 2025, Ethereum looked completely stuck. Sentiment was terrible, confidence was low, and many investors had written it off. Then the narrative shifted. During the middle of the year, Ethereum staged a powerful comeback. From spring lows near $1,400, ETH more than doubled, eventually pushing toward its previous highs by late summer. Institutional adoption, ETF optimism, and a sense that Ethereum was finally catching up to Bitcoin all played a role. However, the rally did not last. As quickly as momentum returned, it faded. Ethereum suffered a deep correction, wiping out a large portion of those gains and dragging price back down into the high $2000 range. This violent reversal left many investors confused and frustrated. So what changed? Why did confidence evaporate so fast? There are three major forces that explain Ethereum's struggles. The first is the Layer 2 controversy. A growing number of critics argue that Layer 2 networks are extracting value from Ethereum rather than supporting it. When you look at the raw numbers, it is easy to see why this narrative gained traction. Before major scaling upgrades, Ethereum's main chain was generating tens of millions of dollars per day in transaction fees. Today, that revenue has collapsed dramatically. Fees are so low that Ethereum's famous burn mechanism barely offsets new issuance, flipping ETH from deflationary back to inflationary. From this perspective, Ethereum looks less like a profit-generating network and more like a low-margin settlement layer. Layer 2 chains execute transactions, collect fees, and keep most of the value, while Ethereum provides security in the background. High-profile examples, such as large exchanges running their own Layer 2s, have reinforced the idea that Ethereum is doing the hard work while others capture the upside. But this argument ignores a crucial detail. Despite falling revenue, Ethereum continues to attract massive capital inflows at the base layer. Investors and institutions still trust Ethereum as the most secure place to store value and settle transactions. Even if users interact on Layer 2s, the economic gravity remains centered on Ethereum itself. The second issue is ETF disappointment. When Bitcoin spot ETFs launched, price surged. When Ethereum ETFs followed, the market reaction was underwhelming. The reason comes down to yield. Holding ETH directly allows investors to stake and earn a return. Spot ETFs, at least for now, do not offer that benefit. For large investors, paying management fees for an asset that provides no yield simply does not make sense when staking exists as an alternative. Adding to the problem were large outflows from legacy investment vehicles. As newer ETFs became available, older products with higher fees saw heavy selling pressure. Billions of dollars worth of ETH hit the market, overwhelming fresh inflows and keeping price suppressed for months. The third pressure point came from corporate treasury strategies. Earlier in the year, several companies attempted to replicate the Bitcoin treasury playbook by accumulating large amounts of ETH. Initially, this boosted confidence. But as prices fell, many of these firms began trading below the value of their holdings. Some were forced to sell ETH to stabilize their stock prices, creating a feedback loop that pushed prices even lower. Taken together, it is easy to see why Ethereum looks weak. Revenue is down, ETFs have struggled, and corporate buyers are under stress. On the surface, it feels like a perfect storm. Yet when you zoom out and focus on fundamentals rather than price, a very different picture emerges. This is what can be called the institutional paradox. While retail sentiment has collapsed, institutional adoption has quietly accelerated. Major financial players are not abandoning Ethereum, they are doubling down. Tokenized real-world assets, particularly government bonds and stablecoins, overwhelmingly settle on Ethereum. The majority of dollar-pegged stablecoins still live on Ethereum, forming the backbone of the entire crypto economy. Large asset managers have chosen Ethereum not because it is the fastest chain, but because it offers regulatory clarity, deep liquidity, mature infrastructure, and long-term reliability. These are the qualities that matter when trillions of dollars are at stake. Speed and hype come second to trust and security. Even among corporate treasuries, not everyone is retreating. Some firms continue to accumulate and stake ETH, betting that today's weakness will look like a bargain in hindsight. This creates a strange disconnect. Market price suggests decline, while real-world usage and institutional commitment suggest growth. Historically, when price and fundamentals diverge this sharply, it often precedes major reversals. But for that to happen, Ethereum needs a catalyst, and that is where 2026 comes into focus. Ethereum's development roadmap over the next year is one of the most ambitious in its history. Upcoming upgrades are designed to improve scalability, decentralization, and efficiency without sacrificing security. These changes aim to make the network lighter, faster, and easier to participate in, addressing long-standing concerns about complexity and state growth. Beyond technology, regulation may prove to be the biggest trigger. The possibility of Ethereum ETFs that include staking rewards would fundamentally change how institutions view ETH. Yield transforms Ethereum from a purely speculative asset into a productive one. For pension funds, wealth managers, and long-term investors, that shift is enormous. So where does this leave us? Ethereum is not dead. A network securing hundreds of billions of dollars, hosting the majority of stablecoin liquidity, and serving as the settlement layer for global finance does not simply disappear. At the same time, Ethereum is clearly out of favor. Sentiment is weak, narratives are hostile, and competitors are dominating attention. Markets move in cycles. Assets written off during periods of extreme pessimism often deliver the strongest returns when conditions change. Ethereum has been declared dead many times before, and each time, it eventually proved those claims wrong. As we head toward 2026, the gap between perception and reality around Ethereum is wide. Whether that gap closes through renewed hype, regulatory breakthroughs, or structural upgrades remains to be seen. But one thing is clear, writing off Ethereum entirely may be a mistake. This is Web3 verse. The question now is yours to answer. Is Ethereum a sleeping giant preparing for its next chapter, or has the ecosystem fundamentally shifted away from it for good?